here several times to teach students, MBA students, at the university of risk management. So now we talk also about risk management. And actually the topic, are banks special? It really fits the title of the conference because we are talking about financial stability, which we had on the title. We will talk about regulation and about global financial markets and the issue of procyclicality that is connected to the amount of capital banks should hold probably in the future. I'll talk about two major policy issues that I think are crucial for the banking industry, for the world economy. And some of the topics are old topics that were discussed, but I think that still we are far away from finding the right optimal solution. One question is why banks and insurance companies, I should say, are subject to regulation concerning the capital, the equity capital. We don't find the same regulation for internet companies, for industrial companies. Only for banks we have this special regulation that is becoming even more severe concerning capital requirements. And the second question, which is related, is why banks all over the world are so highly levered. According to the latest statistics, and I should really qualify it, the leverage of banks is something like 90 to 85%. So we have equity, and I'm talking about accounting equity, that is maybe 10%, 15%, and probably the real equity is something like 3-5%. And here I have to immediately say, accounting numbers, especially concerning banks, lie. They don't give us the right story. You know, we try to correct it in Basel I. Actually, if you look at the foundation of Basel I, that dealt with capital requirements for credit risk, the whole idea was to translate off balance sheet to balance sheet equivalence. It was the first time that actually regulators, bankers realized that a lot of the risk is hiding not on the balance sheet, but off balance sheet. So the idea was to translate, and it was very, very simplistic, extremely simplistic. By the way, I don't know if you know, they started before it was moved to Basel. It was a joint effort of the Fed and the Bank of England, starting from something like 1984-85, to find a formula for capital requirements concerning credit risk. And they came with all kinds of ideas, including Monte Carlo simulations and modeling and contingent claim approach. And then somebody said, stop. If you want to, any implementation, keep it simple. So they did the simplest method possible. On a matchbox, you can do the calculation and the translation. But a lot of the risk is hiding in off-balance sheet, and therefore the accounting numbers, and I'll talk about it also in the empirical context, because I'll survey and cover some of the issues and some of the arguments that are being discussed. And if anybody wants a paper, please let me know and I'll send you the paper. Only let it move.
You have this one?
Yes, I'm still open here. Control. Okay, page down. Oh. And the question is really, are banks so special that they can justify financing themselves mainly with debt? And again, prior to the crisis, to the GFC, some estimation of bankers and regulators is that actually many banks ran with something like 1 to 3% equity. By the way, if you recall the Japanese banking industry in the 80s of last century, About 10 Japanese banks were rated AAA in the 80s. How many were rated AAA in the 90s already? Of course none. Now the issue was that Japanese banks in the 80s were very profitable and they were conquering the world, but with about 1% equity. They had no capital requirements whatsoever, no regulation in Japan concerning capital. So they were extremely highly levered, 99 to 1. So they were very successful in merging and purchasing financial institutions in Europe, in the United States, everywhere, controlling the Eurobond. But once economic climate has changed, very fast they collapsed because they were so highly levered. So the lesson was not well studied later on, and all over the world, many of the major banks had really real equity, and I'll talk about it, of 1 to 3% only. So really the GFC really unveiled the vulnerability of banks, excessive borrowing. And by the way, when I talked about the accounting numbers that lie, remember that Lehman Brothers that collapsed on September 15, 2008. The last balance sheet was for August 31, 2008. Just sort of 2 weeks. It was published later on, but it was 2 weeks before the collapse. It showed positive $24 billion in equity. Now, how can it be that you show on the accounting, on the balance sheet, $24 billion, and 2 weeks later you collapse and you show a loss of something like $400 billion? So that's when I'm saying that the accounting numbers don't tell us the right story. So for all of us who are engaged in empirical work concerning banking and equity, etc., and I'll talk about some, be very careful about it. Okay, so what are the three effects that seem to have been responsible for the global impact of the GFC? First, when one institution's asset sale depressed prices, it affected other institutions. So there was a contagious effect. So when you have to sell assets, you affect immediately additional asset substitution effect, and it affects other institutions. Second, we have the contagious effect also through concerns. When we have banking institutions that are on the verge of collapse, it really affects the whole industry, and the Fed was very much afraid of 1929 lesson, runs on banks. I think that it was really bitter experience of that period that affected a lot of what we have today, also concerning regulation, including the FDIC, and I'll mention it. The third effect is really the issue of liquidity. Most of the borrowing of banks was short-term, investments were long-term, and actually when they needed liquidity, it dried up. And by the way, most of the major collapses in the world, including LTCM, were due to liquidity, not so much equity. Sometimes we confuse the terms. You can have a lot of equity and no liquidity, no value. It's drying up, values go down, and what you think that you have, that you can realize, you cannot. It disappears. Okay, so the regulators respond to the GFC immediately with Basel 2.5, and they add the stressed capital requirement, which is, in my view, very, sort of how should we say, it's not very clever way to correct some of the issues, especially after the horses ran away from the stable. It was overdoing the Basel 2.5. Basel 3, and only to remind you the dates, Basel 2 was implemented in some places only in 2008. In other places 2009, in many places it was never implemented. I don't know if you realize, but the United States is still on Basel I. The United States never moved to Basel II and 2.5. The regulation in the United States forces some of the major banks to use the advanced Basel III, but still it's not on a formal basis, adapting it for the whole industry. Okay, so the question is why in corporations, industrial corporations, leverage, at least in the United States, is about 50%, and in banks we allow 90%, 85%. Now, since I come from academia, Miller was my teacher, influenced me quite a lot. So if we accept M&M propositions, the 58 propositions, we have to ask the issue, why are we so much concerned about capital in banks? Why do we have to allow banks to hold so little capital? Because if we accept M&M, proposition 1, it says that the value of the franchise as a whole doesn't change with capital structure. If we accept proposition 2, it says that the rate of return, expected rate of return on equity, will reflect the financial risk, the leverage. It will reflect it fully. So if you are highly levered, shareholders will ask for higher expected rate of return. If you are less levered, the rate of return on equity will go down. The expected rate of return. And the value of the franchise is not going to change unless there are deviations from the basic assumptions of M&M. So we know that one deviation is taxation. So the question is whether taxation is so important in banks compared to other companies that moves them to 90% leverage. So I think that the starting point in any academic discussion, any practical discussion, should start with M&M propositions. And the argument should be what's wrong with the propositions that we should allow bankers to be so highly levered. Okay, now what are the major roles of banks? And again, it's in all literature you have it. So we know that one is liquidity and payment services. Bank provides liquidity, payment services, unlike any other institution. It's an important task for society to provide those services. Banks also engage in maturity transformation, taking short-term deposits, turn them into long-term investments, loans, and they help to create more jobs, to promote industry, etc. So it's a very important role of banks in transforming short into long-term by diversification and allowing enough liquidity to the deposit holders while engaged in long-term investments. But the question is it so important that governments, implicitly or explicitly, should subsidize those services? You know, on one hand, they are private. It was privatized. Banks are not owned by governments anymore in most places in the world. But at the same time, they rely on some subsidies. Too big to fail, FDIC. In most places where you have deposit insurance, it's not priced correctly, it's subsidized. In many other places where you don't have formal deposit insurance, you have an informal one. So when the bank fails, immediately the government goes in, puts a lot of money, and after the GFC, and we just heard it in the introductory note today, how much money is being given to banks to promote them, to give them enough liquidity to overcome the results of the GFC. We are talking about 8, 9 years after the GFC, and we still have to put so much of public money in the banking industry to support, to fulfill the jobs. So if I have to count, I said 2 points here. We have a third one. Banks have advantage in information processing. They have the skills, the economies of scale, so they can provide loans and assess them better than any individual or any other institution that is not a bank. And lastly, number 4, among the boards of the banks, is managing risks. Today, banks are engaged in risk transformation. Even more than maturity transformation, it's risk transformation. Taking certain kinds of risks and repacking them, diversifying, hopefully, that they were thinking in the subprime market, that they diversify enough by geography, etc. It didn't help much. And the issue of correlations is something that we should always keep in mind. When we manage risk, correlations are extremely important. Until the day that we have a crisis and all correlations jump to +1, -1, and diversification disappears. So no doubt that for the smooth operation of the economy, we need well-functioning banking industry. But the question is how to assure the system. Now, again, there's an evolution. We had the crisis of 1929 that went over 3 to 5 years. A lot of banks collapsed. There was a ban on banks. It was very traumatic. As a result, the FDIC was created. As a result, the idea was how to prevent run-on banks. And the idea was if we insure depositors, they will have no reason to run on banks. So we started to insure depositors. But what was the consequence? Depositors didn't care anymore about the risk of the bank. If before they should have been concerned with the other insurance, now they don't care anymore. And what the bank's reaction is, especially that it's subsidized, to increase leverage. By the way, before the crisis, in the 19th century, banks as a private institutions held something like 40% equity. And usually above 20% equity, they were not highly levered. Why? Because depositors were concerned about the risk exposure of the bank. Once we have government assurance, we don't have to worry about leverage. So now leverage can go up to 90, 95, 97, 99%. We are not concerned anymore because our money as depositors is safe. So now we are going to Basel I. And Basel I was a response to 2 major effects in the 80s. To remind you, the Basel I, the first one, the Accord, the 88 Accord, was written in 88 to be implemented only in 92, January 92, and it concerned only credit risk. Now the trigger to Basel and to the negotiation between the Fed and Bank of England were 2. One I mentioned before, it was Japan. The dominance of Japan in the 80s, in the banking industry, in the Eurobond market, concerned regulators in the United States and England. They didn't like the competition that was unfair. Competing on English soil, American soil, with Japanese rules. Meaning no rules, as far as leverage is concerned. So they decided they have to set rules for world competition in the banking industry. So that was trigger number 1. Trigger number 2, that Menachem will relate to, when he will talk about derivatives, was a huge expansion in derivative trading in the 80s. Especially in the OTC market, they exploded, they moved, they became huge. For those who don't know the numbers today, the OTC notional value is about $700 trillion. Compared to the US economy, GDP of $16 trillion. So the world derivative market, one-sided, long, same is short, of course, is between 6 and 7, close to $7 trillion. So we're talking about huge market, not fully regulated, not fully covered as far as credit risk, market risk are concerned. And since it grew so much in the 80s, it was a major concern of the Fed and the Bank of England. So that was really what was behind Basel I. And Basel I had two issues, two innovations. One, as I said, was a translation of off-balance sheet items into equivalent, balance sheet equivalents, but only concerning credit risk. 88 was only concerning credit risk. And innovation number two was the creation of risk-weighted assets. So risk-weighted assets deviate from accounting assets because many of the assets on the balance sheet are not considered to be risk-weighted as far as credit risk. For example, all the banking book is not part. It's only the banking and not the trading book. Okay, it's not the real estate. It's not other real assets. But at the same time, you move some assets from off balance sheet into equivalent. So the risk-weighted assets is not really consistent with what we see in the accounting numbers. But then the pivotal number, the 8%, is against the risk-weighted assets. But only those that are sensitive to credit risk. Not to market risk, not to operation risk, only credit risk. Also Basel I, maybe it's the third big innovation, introduced Tier 1, Tier 2, and Tier 3 capital. Again, beyond and against all accounting rules. Because Tier 2 and Tier 3 are mainly debt obligation. Very long term, some are short term. All of them are inferior, they are unsecured and usually next to equity as far as priority in case of bankruptcy. But they are not real capital. And we saw in the crisis in the GFC, Tier 3 and Tier 2 evaporated. They didn't help the banks at all. So Basel III is correcting, especially for a Tier 3 capital. So Tier 1 capital is really tangible common equity. It's really what we usually call equity. Tier 2 capital consists of subordinated debt and contingent convertible capital, such as the COCOs. And by the way, they don't provide absorption because what happened under crisis, they didn't absorb the losses. On the contrary, banks try to maintain them in order not to show that they are failing. And Capital 3 was for sure not supporting and not absorbing losses. We are talking about 2 years debt obligation, again, that are inferior as far as the priority is concerned in case of bankruptcy. Okay, let's talk about some of the conflicting views on the appropriate leverage ratio in banking. So, first of all, the accounting approach is dominant in regulation. Basel I, Basel II, Basel III, they are all based on accounting data as far as measuring equity. There's nothing about market value, and I'll show you some of the statistics. So we have this tension between market values and book values. But all regulation today is based on accounting equity, accounting debt, obligation, etc. Okay, before the GFC, in 2006, banks in Europe and the United States had market values that was twice as high as book value, and many had even 3. I don't know if you know you ever saw the nice circles, the value of the banks before the GFC and then in January 2009. So Citibank was $40 a share before. How much was it in January, February 2009? It went down from 40 to less than $1. So the value of Citibank shrank. The market value of equity of Citibank shrank by more than 90%. And today when you see 50, remember it's only 5. Because they did reverse split a few years ago. So Citibank today, at the price of 50, the true price, comparable price to the GFC, before the GFC, is only 5. So that's still 1/8 of the value before the crisis. Okay, so we have an issue, book value or market value. And to remind you, all theories, M&M, KPM, etc., are based on market values, not on book values. So we have this gap to bridge. What numbers do we use? Here you have some of the numbers. It's hard to see the scale, but I'll tell you. The scale here are years before 2006 and 7. And here you have month in 2006, 7, I think it's going all the way to mid-8, 2008. And you see that in different countries, especially, you have Ireland and I think Spain that are here with market value that is 3 times the book value. Most of the other countries have a ratio of 2. By the way, all the countries have a ratio above 1.5, around 2. Only to go below 0.5, later on and even below. That's the beginning of the crisis, or the middle of the crisis. But if you continue it, you see it went even further below. So yes, we have an issue, again, in academia, in research, and only translating into practice. What numbers do we trust? I don't think we trust accounting numbers, but the question, can we trust market value numbers when they are so volatile and sometimes we think we have overreaction in good times and then in bad times. So I'll keep it an open issue. Okay. Some recent empirical studies, I just saw 2 studies, interesting studies. One by Rob and Hyder, it was published in the Review of Finance in 2010. They actually tried to explain leverage in banks compared to leverage in non-banking companies in the United States and in Europe. And lo and behold, they find that actually the same factors explain the differences, the diversity in leverage ratios. And usually they claim that more profitable banks, banks that pay high dividends, like non-bank corporations, will have less leverage. So they find the same factor, but they don't try to explain the level, only the distribution. Okay? Now, although they have 2 interesting findings, they claim that actually most of the borrowing or most of leverage in banks over the last decade were non-deposit liabilities. Many, all kinds of structures, but no deposits. So it's really sort of against the idea that banks are trying to increase the deposits because they are subsidized. So it's indirect evidence that it's not the FDIC, it's not the subsidization of deposits that is promoting more leverage. coming. It has mind of its own. Okay, and also they claim that capital regulation will have second-order importance in determining the capital structure based on their evidence. Another study that is still, I think, unpublished by Berg and Gider, they show the numbers, two numbers actually for banks and non-banks. They claim that leverage in banks is 86% compared to non-bank corporation where the leverage is 49%. But at the same time, they claim that volatility of assets, and you can ask how it's being measured, book value, market value, etc., or equity translated into value of the assets, but it's only 5% in banks compared to 25% in non-bank corporations. So the claim is actually that yes, banks may have additional leverage, but after adjusting for volatility, they claim the excess leverage is maybe 5%. But again, the way they do it is inconsistent with theory. There's nothing to do with the M&M propositions, because the M&M propositions are sort of regardless of volatility of assets. Volatility of assets is not going in the derivation in the proof. So yes, it's interesting data, both studies, they have interesting data. And you can argue about the validity of some of the numbers they use, etc., but still it's pretty strong evidence that may explain something, but again, we don't know how to bridge it with the theory and the different approaches. Okay, now we have proponents of, let's forget about regulation, and I'm talking about that Martin Helwig in the famous new book that came up a year ago, 2 years ago, The Banker's New Clothes. And they argue, they promote, and they go around the world promoting it, they claim, forget regulation. Let's move to 40% capital requirement on all banks. Now, you have to think about it. The bankers here, usually the bankers oppose it. They say, nonsense, you don't understand, and we'll show some of the arguments of bankers, and show that they're not exactly right in the eyes of, again, from the point of view of M&M. But still, remember how costly is the regulation. I don't know, I'm sure that the bankers here realize how many billions of dollars were spent in the world over the last 20 years on complying with Basel I, Basel II, 2.5, and now 3. Banks spend tens of millions of dollars a year on compliance. I know from a bank that my friends were associated with, in 1995 there was one person in risk management. 10 years later they had 600 people in risk management to comply with regulation. It's a huge expense. So maybe it's better to save all the money and move to 20, 30, 40% equity capital. So we can dismiss it. And by the way, I'm personally in favor of forgetting about the detailed regulation, all the risk-weighted assets and calculation and manipulation around it. You see, one of the issues with regulation, that there's a sort of collateral cost of manipulating it, trying to avoid it, trying to circumvent it, which is very costly to all, because now regulators have to hire more people to find how it's being circumvented. What is the right number? So maybe it's better to stop this game, to have something simple, and to agree, okay, at least 20-25% equity, and forget about the detailed regulation, with all the costs involved. So the question is, what is the trade-off between detailed regulation and higher equity? Okay, so first of all, we know that the risk-weighted asset calculation is really not very trustworthy. We know that it's being manipulated. We know that many of the financial innovations of the last 20 years, including a lot of the securitizations, were a result of regulation. Not because banks wanted to securitize, but by securitizing, they could take a lot of the risk assets away from the balance sheet. And sometimes hiding the real risk still in the equity tranche that they were holding. In Europe it was not allowed, in the United States, yes, it was allowed. So again, you have how to manipulate the system. So you try to eat the cake and to keep it whole at the same time. That's actually what happened before the GFC. So the alternative to the regulation could have been to raise equity to 20% and forget about it. And we have different views from bankers from England and other places, and you can look at the papers, interesting short papers, about what true capital is doing to banks, showing that actually true capital, Tier 1, is helping banks via the crisis, through the crisis, while Tier 2, Tier 3 were not too helpful, and actually calling for much more to the banks to hold much more of Tier 1 equity. So what bankers are arguing against this approach for more capital? They claim that more capital will force banks to charge higher interest rate on loans and restrict banks' ability to finance the economy. So the banks are frightening all of us. They say if you impose higher equity, stop, we can't give loans. Or we charge more on the loan because the price is higher. By the way, it's really, really against the basic idea and concept of M&M and pure economic thinking. When you charge, and I'll come to it because I'm a very strong proponent of the contingent claim approach. In the contingent claim approach, you charge a client, a borrower, whatever based on the profile of the borrower, not on your profile as a bank. You know, the idea that, and by the way, it has to do with accounting in banks. Banks, they have the transfer prices mechanism, which is utterly, sorry, but utterly stupid. Because you don't, whatever you want to charge your client should be based on the profile of the client, on the credit risk of the client. So it's based on the balance sheet of the client, on the leverage of the client, on the riskiness of the client business. It should be based fully on the client and not on you. If you earn from the diversification, it's between you and your shareholders, not between you and your client. In other words, if you want to subsidize a client, fine, but you should know that you are subsidizing. If you are not charging the right price, your client, based on the profile of the client, you are engaging in cross-subsidization. And it's really the difference between the traditional insurance, where you have pools and you do cross-subsidization, and the today direct insurance, where you put in your details and the computer speaks a number and says that's the rate that you should pay. Based on your age, your experience, your residence, etc., your profession. They have about 20 characteristics, profiles for each individual, and you pay a specific rate based on your profile, based on regression analysis over many, many clients in the past, etc. No cross-subsidization in direct insurance. So the question is, do we want to have banking that is based on cross-subsidization, or do we want banks that are based on the right pricing, based on the client with no cross-subsidization? If you accept the second, this approach, this argument is not true. And capacity to lend money is based not only on deposits. You can lend money from equities that you raise as a bank, from different financial instruments that you raise. It doesn't matter what's the source of financing. So, we'll come to it. And again, we come to the comparison. So why banks are so special? Why in non-bank corporations they can live with 50%? Apple lives with, how much, 5% in Apple? Very successful corporation, no leverage. Microsoft, hardly any leverage. Google, no leverage. So we see many of the successful corporations in the world, they could easily lever their position, they don't do it. So the question is why? How can we explain this contradiction? Now another argument of bankers is that they must produce a minimal return on equity. But again, it's, this argument that they have to show return on equity cannot be unrelated to the amount of leverage they have. If they have more leverage, yes, based on proposition 2 of M&M, they should ask for higher, they should show higher expected rate of return on equity. But if they reduce the leverage, also investors will require less expected rate of return because they are exposed to less financial risk. So the argument that they always have to show 15% or 20% doesn't make sense because it ignores completely the financial risk element. And again, we have all kinds of arguments in theoretical papers like Myers and Mylov about the effect of equity, that if you raise equity, you signal something to the market, that the price of equity may be overpriced. But I don't think it's a really major argument that is made by banks, why not to raise more equity. And by the way, when I said initially about the procyclicality, yes, we have an issue. If we ask banks to raise more capital, it will put a lot of pressure on financial markets, global financial markets. We'll have an issue of procyclicality. So we have to be very careful about how we handle it and over what period of time we use to ask banks to hold more capital. Okay. Why these arguments of bankers are false? I told you very briefly, but I had 2 papers with Michel Coury, who couldn't come today, unfortunately, from 86-91 in the Journal of Banking and Finance, where we use a contingent claim approach. And we showed that actually there's a lot of confusion also between bank capital and cash reserves. They are in different parts of the balance sheet. Yes, there is some substitution. When you hold more reserves, more liquid reserves, you need less equity in order to balance the risk that deposit holders do face. So if our starting point is unregulated markets, competitive markets, perfect capital markets, really depositors should ask for rate that is consistent with the riskiness of the bank, of the assets of the bank, and with the leverage of the bank. But once we have deposit insurance, this sensitivity of rates disappears. Nobody, no depositor, is any more concerned about the riskiness of the bank and the leverage of the bank. So the cost to society of the FDIC, yes, we solved one problem, which was ban on banks, but we created additional problems, and that's the insensitivity of depositors. And hence, also the tendency of banks to increase the leverage to the benefit of the shareholders, because they maximize the subsidy. Okay, so as I said, really, we should put the different pieces in the right order. So the right order is that loans to clients should be priced on the profile of the borrowers, not on the profile of the bank. The cost of capital of the bank has nothing to do with how much we charge a client. Also, as far as sources for new loans, capital structure is actually irrelevant. And as I said, the cost of equity, the return on equity, is really a function of the leverage of the bank and the volatility of the assets of the bank, which we know is lower. Okay. Since I have time pressure, so banks are different because they have subsidies and they have support by the government. And by the way, there's three issues that other corporations don't have, especially after the GFC, is really free access to a lot of cash reserves, and we heard about it today now in Europe. By the way, in the world over the last 6-7 years, about $7 trillion were printed. Most of them went to the banking industry. So banks in different places, United States especially, but also in China and other places, got very cheap money with which they bought government bonds that paid them more. And that's how banks became profitable over the last few years. They didn't become profitable because they were so smart and they learned from their mistakes. But they were given a present from the taxpayers. And we will have to study it in the future to see how much subsidy was given to the banks through all the programs to help them. Banks can count on being bailed out. Yes, we have now the Dodd-Frank in the United States, the living will, which is, again, something I don't understand, how they want banks to publish a book each year about the living will, what they are going to do in case of crisis. And I mean, it's a nice book, it's nice literature, but I think it's completely non-practical because you don't take the effects, the contagious effect of one bank on another. It's sort of each one stand alone. I don't know. I think it's the role of the federal bank or the central banks and not of each individual bank about the stability. So that's, to the stability people, I think it should concern you. This issue of living will, that, again, I don't understand. I don't know what you're going to do with it. And number three is the underpriced deposit insurance, which is also a way to subsidize banks that is not in other industries. In our paper, and again, I'm not going to do it, but we showed actually that in competitive banking industry, if here we have capital ratio between 0 and 1, okay, so if you have any capital in the bank, any ratio that you want to hold, depositors will charge you a rate. So here we have the required rate on deposits based on contingent claim in free market with no insurance. Okay? So once you determine how much equity you can have, less equity, you can have more equity. If you have less equity, the banks will charge you more. Depositors will charge you more. If you have more equity, the banks will charge you, the depositors will charge you less. If everything is financed by equity, you'll get a risk-free rate. Depending on the volatility of your assets, almost risk-free rate. So in free banking, with no subsidies, that's a relationship between return on deposits and equity. Once you introduce deposit insurance, the deposit insurance will be something like that, and it depends how much you charge. If you charge the right price, you'll have an optimal capital structure. If you charge, here for example, you have a subsidy, So it's really an incentive for banks to hold less capital because they are being subsidized. So again, if you want, I'll give you a reference to these papers and we'll go to the conclusions. So by the way, the contingent claim approach can be very helpful to analyze many of the issues in much more succinct and orderly way, to put each piece in the right place. And I can tell you, I was almost thrown from one of the major insurance companies in the United States. I gave a lecture on something related, and I told them that the cost of funding and the way they charge for different, what they do on the asset side has nothing to do with what they do on the funding side. And they said, no, you don't understand. They were talking, supporting the pooling and transfer prices. They say, we do it for so many years. After the GFC, the chief risk officer of the bank called me, of the insurance company, called me and says, now I understand what you told us. Okay. So the conclusion is really, the starting point is M&M. We have to find any deviation and to see whether the deviation is really significant, sufficiently significant in order to deviate in our behavior. Personally, still I believe that banks should hold more capital. I think that even 20% is fine, and especially if it will come at the cost of reduction in specific regulation that is costly. So I'm for reducing the cost of compliance, but at the same time holding true equity. I'm for market value against book value because I don't trust the book value in the accounting way of dealing, especially with the off-balance sheet. But again, that's my personal bias, and we can discuss it later on in the coffee break. Thank you very much.
I think we have time to discuss it now. And I mean, the point you raise is interesting. First of all, Modigliani and Miller, in order to step away from Modigliani and Miller, we have to have evidence that this doesn't work. Also, the second evidence is that the risk manager, the CRO in this room are useless, so we have to fire them and to just increase the capital. No, I'm joking. Just trying to make to the extreme your conclusion. So I would like to open the floor to questions.
Maybe I can start off. First of all, good morning, everyone, and thank you all for attending our conference again, and thank you, Dan, for a very stimulating talk. And I'd like to make two comments. First, despite the continued